Sebastian Bunney, welcome to the podcast. How are you?
Brian, honestly, it's my pleasure. I'm really looking forward to chatting. You reached out and I was like, this seems like a good podcast to chat.
So, this is a subject that I wanted to talk about on the podcast for a long, long time. And I have gone down the rabbit hole, as we just discussed before I hit record. I've spent God knows how many hours reading books, listening to podcasts, listening to you talk about the subject of Bitcoin. And I feel like I'm still scratching the surface of it. So I think what I really wanted to do for this podcast is give the listeners a really good overview of Bitcoin. But more importantly, the thing that everybody's feeling themselves is that something is wrong. Like a lot of people can't put their finger on what it is. I know you're based in Canada, and I'm sure it's the same there. I'm sure it's the same in the US, and I'm sure it's the same in the UK. People feel like they're just struggling over time. Even if they're earning more money over time, their salary's increasing, their take-home pay is increasing, they still seem like, why is everything getting so expensive? It doesn't feel right. What, like, people can't get on the property ladder, and I feel like there's an underlying reason for that. So the first question I want to ask you, and is probably the biggest question I've ever asked anyone on this podcast, is what is money?
That's a big question. That is a
Yeah.
big question. So if we take a step back for a second, I would say that for most people, when we think about money, we just think, oh, this is a medium of exchange. We use it to buy goods. And how much of an influence can money really have on our everyday lives? And the reality is that money is incredibly powerful. Money really does weave its influence into everything we do, how we show up, how we spend, you name it. And just to give you a couple quick examples, which I'm sure we can dive into, whether or not we save or consume is built around our money. If our money is worth less over time, well, then we're incentivized to consume, given it's worth the most in the present moment. So we start decimating our waterways and our forests and our natural resources because we have a very consumption-based society. What about parents? Well, when parents have to work more because their cost of living is rising, all of a sudden they have less capacity to meet their child's emotional needs. So we're seeing rising rates of anxiety, depression, allergies, you name it. And all of this, or many of these factors stem from kids not having their emotional needs met. And then the same thing with politics. Politicians no longer have to listen to their populace because they have a money printer. They can fund operations without support. Historically, if they could only fund operations through taxation, they start having to listen to their populace. And so when you start looking at all of these factors, you start to realize, wow, money really does shape the world in which we live in. And that means that if money is broken or no longer serving the needs of people, that's a huge, huge problem. And so I think to answer this question, what is money? The way that I think about money personally is like language, money is a medium of expression. It's how we express to the world what it is that we value. We go and work hard and we expend time and energy, and then we want to be able to spend that money on things that we value. So if you walk into a grocery store and you see someone buying organic vegetables and grass-fed beef, and then another person going buying microwave meals, cigarettes, and candy, you can see what it is that they value through how they're spending their money. Now, what is interesting is also like language, it can be censored. So we can be censored in our ability to spend our money because there can be restrictions that say you can spend money here, you can't spend money there. Not only that, inflation is a form of censorship because if you think about it, if prices are rising over time, if I'd worked hard and I'd saved to go and spend my money where I see fit, but all of a sudden I can only go purchase half of what it is that I wanted to go spend, well, I can only express myself I can only express a margin of what it is that I want to actually go and express. And not only that, but when it comes to inflation, it's not as if that purchasing power, if costs are rising, that purchasing power doesn't just disappear. Those that are in control of the money printers, the banks, the people that are in control of monetary issuance, they're the ones that benefit and they can use that purchasing power where they see fit. And to give you an example, for me personally, I do not support war. I'm not going to go and direct capital towards endeavors that support war. And in a free market, well, then that means that limited capital, if the majority of the populace were to spend money on things that supported other endeavors other than war, means that war would slowly wither away because there's not enough money going towards it. But unfortunately, in our monetary environment, when the government goes and funds war at the currency's expense through debasement, through the printing of money, when you look at society on a whole, it looks like, hey, there's lots of capital going towards war. That must mean society supports war. And so what ends up happening is this example that money is a medium of expression. money in its current form distorts how we express ourselves. So I may not support war, but the government can slowly command my purchasing power and go and fund war. And so we get a very skewed idea about what it is that society values. We don't know what industries should exist. We don't know what businesses should exist because there's a lot of government stimulus. There's a lot of government intervention propping up industries, propping up businesses. And finally, you'll also see things like capital controls. And that's another form of censorship. If you live in China and what you value is supporting your family, you want to support your kids, you want to put food on the table, and you realize, man, my purchasing power isn't going as far. I need to go and invest this somewhere. So maybe I'm going to go invest overseas to protect my purchasing power because it's not doing very well, the investment market in China. Or China have capital controls that make it almost impossible for money to leave China. And that's beneficial to the Chinese government because if they want to devalue the currency, the more currency they can keep in the country, the easier it is for them to devalue. So ultimately, again, it's another form of censorship. It prevents that individual that wants to support their family supporting their family. Instead, they're stuck underneath debasement, inflationary regimes, and they just have to face it. So all of these things, whether it's capital controls, inflation, restrictions on where we spend our money, are a form of kind of monetary censorship. They're censoring our ability to express ourselves. And that's really, really important. Expression is incredibly important because expression shows us what society values. It shows us what industries are thriving, where capital is flowing towards value, where value is being created. That's kind of a quick little overview about how I kind of view money.
That's an interesting way of looking at it. So essentially, we have lost control of how to express like a language, what the things we value, because the government have control of the money printer. Essentially, if we want to word it in that way. So essentially, we both the UK and the US and Canada all claim to be free markets to some degree. Is that true? Are we a free
Not,
market?
not at all. Not at all. If someone controls the money printer, ultimately it gives them the capacity to stimulate the economy where they see fit. So if they're bailing out businesses that are too big to fail, if they're pumping capital into certain industries to support those industries, that's an artificial market. And I'll give you an example. I talk about this. I wrote a book that was released in December called The Hidden Cost of Money. And it basically talks about how money weaves its influence into all these different aspects of life that I've kind of briefly discussed on. But in that book, I discuss why intervention is not the answer and why it kind of leads to economic collapse. And this will kind of answer your question about like, do we live in a free market? Now, there's 4 stages to economic collapse in society. And those 4 stages, they start with a misalignment to reality. And this is what we're facing right now. If we think about humanity since the dawn of time, we have always been striving to get more for less. All species compete, and those that are able to use their resources more effectively and more efficiently survive. And so the human, the Neanderthal that's been able to take stone and turn it into tools, has been able to use its environment more efficiently, and it's been able to maximize its chances of survival. The same thing is going on today. If you look at, say, Blockbuster versus Netflix, Blockbuster used to have to expend energy driving down to Blockbuster, spend half an hour in Blockbuster deciding which DVD, which movie you wanted to rent. Then you drive all the way back home, watch the movie, drive all the way back to Blockbuster, drop it off again, drive all the way back home. All of that time and energy to watch one movie. And now, for pretty much the same price as Blockbuster, you can get millions of movies on demand. And so what you're noticing is that technology is always advancing. Productivity is always advancing. Efficiency is always advancing, and that's through innovation. And the reality is that if technology is always advancing and productivity and efficiency are advancing, then prices should be falling. But the reality is prices aren't falling. We're not experiencing that. And so this is our misalignment to reality. As technology advances, prices should be falling. But in an inflationary debt-based world where a lot of these corporations, a lot of these governments carry a lot of debt, that poses a problem. Because if prices are falling and you're a corporation and you have a ton of debt, then all of a sudden your profits are going to be squeezed. And so as your profits are squeezed, you're not going to meet your debt obligations and you could default. So now the government has to step in. The government has to step in and bail out these corporations to stop the economy from collapsing, even though now you've artificially propped up an economy. You're propping up businesses that should not exist. So that's the first stage, our misalignment to reality. We have a misaligned system whereby prices should be falling. Life should be getting easier for people, but it's not. It's going up. And that's to protect big business from collapsing, which brings us to the second stage, the death of kind of competition and creative destruction. So now if you've got all of these businesses that unfortunately are being unproductive or fiscally irresponsible because they're showing to the world that they're not able to meet their debt service payments. If they were to go under, or sorry, if prices were to fall, they would go under. So the government starts bailing them out. So now all of a sudden, the businesses that actually are offering value, the ones that are being fiscally responsible, saving in order to be able to protect themselves in the event of a downturn, a recession, you name it, those ones there now have to compete against a bunch of businesses that should not exist. So now capital is going towards competition as opposed to research and development, growth, supporting their employees. And so all of a sudden, you're having capital basically just being destroyed because it's going towards competition against businesses that should not exist. So now you've got the death of creative destruction and competition. You're breaking down competition because you're artificially propping up businesses that should not exist. That's impacting innovation. And then that brings us to the third stage, which is capital flow distortion. If you think about it, in a free market, we spend our money on things that offer value to us. And so value flows to where, capital flows to where value is being created. Unfortunately, in this market, where there are so many businesses that should not exist, that yes, they still offer products, which means capital flows towards businesses that are being unproductive and fiscally irresponsible. And so naturally, we've now distorted the market. We've distorted our lens of what is offering value in society because capital is flowing towards where value is being destroyed, not where value is being created. Mm-hmm. And that brings us to the final stage, which is decision-making impairment. If you're a business owner and you're deciding, hey, I want to go into this industry, or I want to go into this industry, or whereabouts is value being created in society? Well, you don't know what businesses should exist, what shouldn't exist. You don't know what industries are actually society values. And it's the same thing. If you're a central planner, a central bank, if you're an individual, you have no idea what is actually truly offering value in society. So we have this artificial environment where we just have no understanding of what actually creates value for society. And if you think about it on a relationship term, if you don't know what your partner's needs are, how do you think you can meet their emotional needs? When we have a breakdown in communication, when we cannot communicate to express what it is that we value, our relationships break down. And it's the same thing in society. If we don't know where value is being created in society, if we don't know what businesses should or shouldn't exist, what industries should or shouldn't exist, it's very hard for us to make important economic decisions. And so that's kind of the problem where we're sitting at as a society right now, is we have no idea where value is being created in society because we're artificially propping everything up.
Mm. I've seen that firsthand in the UK with, I used to work in the public sector. I was a police officer for nearly 5 years. And I saw firsthand how inefficient it was. And even people who weren't interested in learning about money and broken money in particular would all say the same thing. If this was a business, if the government ran the public sector, whether it's the NHS, whether it's the police, whether it's the fire service, if they ran it as a business, their decision making would be completely different. And at the moment, people can feel it, especially with the NHS, the waiting times to get surgeries, to even be seen. If you go to A&E, the waiting times, people are waiting there for 24 hours with a broken leg. They're sitting in a room surrounded by people. And you think, how is this? We're one of the most powerful countries in the world with the NHS, who everyone, holds dearly to their heart as the service that is, above the rest of the world. Yet you can't see somebody with a broken leg for up to 24 hours. And for me, the way I look at that is because the government inefficiencies. And if you go look and see some of the costings of like bandages, for example, because there's government money, it's 10 times the amount that it would be if there was a competing free market of people who are offering bandages. Is this a phenomenon that's always happened, or what is it that's caused this to happen? Because surely there was a free market in the beginning, and now there isn't. What in your mind is the thing that tipped the Western world into this debt-based economy?
So I would say what tipped the Western world into this debt-based economy is the centralization of money. Because if you think about it, in a society, what makes up a society, there's 4 levers. There's the land lever. So the land lever, you can think about it as our natural resources. So there's obviously the forests, and there's the materials in the ground, the minerals, there's the waterways, the food, you name it. You've then got the labor lever. That's us as individuals. It's our ability to join together to add our blood, sweat, and tears into creating value. So you've got builders, and you've got doctors, and you've got, you name it, anyone who is basically contributing their time and energy to society to create value. Then you've got the capital lever. The capital lever is the monetary lever, the ability to be able to add capital, which is effectively like a lubricant that allows people to go and buy capital goods such as like machinery and invest it in buildings and you name it. And then finally, there's the enterprise lever. And you can think of enterprise as like innovation. It's using land, materials, labor, people, and money to create innovative new products, technology, businesses. So these four levers make up our economy. Now, the problem is, out of these four levers, three of them, if you want to create change and you want to pull on that lever, the change is indirect. So I'll give you an example. If you think about land, if you want to really create change in economy, or let's go try and find a new massive store of gold. It takes a long time to really try and find gold. You can pump a lot of money into gold research, trying to find gold. But the reality is that it's not like just because we decide to find a new giant storehouse of gold or oil or lumber that we can just make it happen. It takes a long time. So then the second one, labor. If we want to increase the efficiency of our labor workforce, what do we have to do? We have to lower the average age of the workforce. If you've got a very young workforce, that's amazing. You've got a very productive workforce. But the problem is, people, because of climate change and because of the fear of the cost of living and raising children, people globally are starting to have way less kids, especially in developed countries, especially the Western countries. And so what's happening is because people are having less kids, the labor workforce, the average age is getting older and older and older. So as you get a population that slowly retires, there's a ton of retirees, but not many labor workforce individuals. So then who's supporting the retirees? And we're seeing this in Japan. You end up with this society that slowly starts crumbling. And this is a huge problem. In China, because of their one-child policy, which they had through kind of the 90s into the 2000s, they're supposedly meant to see their population half up until 2050. Canada is meant to see people 60 and above increase 60% over the next 10 years versus 60 and below only increase 10%. And like, I don't know what it is in the UK, but in the US, they are the slowest population growth rate in the last 100 years last year. So what you're realizing, we've got this aging workforce that's not able to support themselves. And so if you want to lower the workforce age, well, that's very, very hard. You've got to have people having kids. That takes a long time. You can't just change the average workforce age overnight. And that brings us to, quickly before we go into the capital lever, the enterprise lever. If we want to bet on technology, so, man, we're going to invest a lot of money into AI. We're going to invest a lot of money into robotics because we want to try and increase efficiency in the labor workforce. Well, again, that takes a long time. Technology is one of these things that, yes, technology can create a lot of change in society, but we can't bet on when that change is going to happen. We've had AI for 50, 60 years. Only now is it really starting to create change in the economy. So we can't bet on land, labor, and enterprise or innovation to be able to create change immediately. So that leaves us with one lever. That's a capital lever. So the capital lever, if you print money and inject it into the economy, it creates change very quickly. So if you think about it, we've got these four levers, three of them take a long time, and then one of them is very efficient at creating change. So over time, the governments globally, those in control of the monetary printers, have recognized this. So they've started to pull on the monetary lever. The problem is you've got the law of diminishing returns. The more you pull on something, the returns of that lever diminish. And so when you look at how much $1 stimulated the economy, that is dropping massively to the point where in time, it actually goes negative. If you take on $1 of debt, that debt is so burdensome that it actually doesn't stimulate the economy. It actually creates more of a burden. And so we're at that tipping point where stimulating the economy of money is no longer really working. And so I would say, to your question, what has kind of caused this? It's a centralization of money. It's those in power recognizing, hey, if we pull the monetary lever, we can stimulate the economy, but they've become too kind of lever hungry and they're just pulling the lever, printing money, taking on debt. And unfortunately, we're now at the point where that intervention, as I explained, is not benefiting the economy. Unfortunately, it's propping up businesses, it's destroying innovation, it's breaking down competition. And it also is leading to these instances where I think those in positions of power, they want to support the populace, but it's very hard for individuals to think about the second, third, and fourth order effects of their decisions. And so in Canada, and I'm sure it was very similar in the States, and I'm sure it was very similar in the UK, during the pandemic, we had something called the CERB, the Canadian Emergency Response Benefit. And so if you'd lost, I think it was about 10% of your income, you were entitled to 2,000 Canadian dollars a month. So that's $24,000 a year. Now, if you actually look at the Canadian tax records, 30% of Canadians earn under $25,000 a year. So if all of a sudden you say to 30% of the population, hey, we'll give you your wage and you don't have to do anything for it, what are they going to do? Are they going to work for the little small business they're working for, or are they just going to take this free money? So of course they take the free money, and then all of a sudden cafes and bike shops and restaurants, they had signs up saying, sorry, we can't get staff, so they have to close down. So now you've just decimated all of these small businesses. We lost so many small businesses during the pandemic. And so there's this belief that, okay, we're going to stimulate the economy, we're going to support the general populace. And in return, this supporting the general populace just decimated the small business market. So now you've just got more and more large corporations that are able to take advantage of the grants and the stimulus, thriving, while the small business, mom and pop businesses are just decimated. And so intervention, it's my belief that intervention, it's hard for people to think about the second and third order effects of something. It may be great to start out, but in the long term, it's taking the power away from the individual. It's taking power away from small businesses. It's taking power away from the free market, which is an incredible organizing force to create value in society.
So essentially, it's making, with probably good intentions for a lot of them, maybe some more nefarious, but good intentions to resolve a problem now. And the quickest way to do that is to essentially print money and give people money, but also because politicians are thinking in a 4-year window, most of them, because they want to get re-elected. So they're going to make the decision that's most impactful now, rather than making the difficult decision that's going to improve humanity and, well, more locally in their country, going to improve their country maybe in 4, 5, 6 years' time. But they're going to be forgotten about, and the new government's going to be the one that's going to be praised for the changes, because everybody thinks about the now. So you can understand why people do it. But for somebody who's heard you say that, understands what you're saying, but doesn't understand what it means to print money, because when people say that, when I say that, people think of, actual, people have always seen videos of like paper money in big sheets that get cut up, and that's what they visualize as printing money. What is the process of printing money, and how have the government even been allowed to do so?
So the actual act of printing money, most people think about, to your point, someone hitting kind of the print on the print button on the printer, and there's big sheets of money, and that money is being distributed. That's a very small fraction of the money that actually enters society. Money many times is actually created in the banks. So banks tend to have reserve requirements. So if a bank, let's just say you deposit $100 in the bank, the reserve requirement historically for a long time in most nations has been 10%. So they've got to hold $10 of your $100 deposit, and then they can go and lend out $90. Now, what ends up happening is if the central bank decides, hey, you know what, we're going to lower the reserve requirement to 5% or 0, all of a sudden that means they can lend out more of your money to society. So if you think about it, if you've deposited $100 and the reserve requirement is 50%, they can only go and lend out $50. If that reserve requirement all of a sudden is 0%, they can lend out that full money. They can lend out more than that money. And so when central banks play around with these certain levers that are such as the reserve requirement, all of a sudden they're now incentivizing those banks to go and lend out that money. They can make more money by lending out money. And not only that, you also see it with interest rates. If a central bank lowers interest rates, what are you doing in society? Well, if you're an individual and you're struggling, well, then you're going to go and borrow. So when you borrow, that money isn't coming from reserves. That money is being created. It's being added into society many times. And so all of a sudden, when you go and borrow because interest rates are favorable, you're also expanding the amount of money in circulation. And so central banks, through the lowering of interest rates, through reserve requirements, and through a whole heap of other kind of levers and tools, they can slowly increase or decrease the monetary supply. And so it's not necessarily directly through money printing. Many times it's through the banks. And what is interesting is you also see it with what is called QE, or quantitative easing. Now, what quantitative easing is, if you are a bank and you have, let's say, some bonds. So your bond, for those who are not familiar, it's a debt obligation. Someone has lent you money. In return, you are paying an interest to use that money, just like a loan, just like any other debt instrument. So this bond, someone has lent you money, and in return, you're paying interest. If these banks are holding these bonds and they're getting a nice little interest payment each month, then that's awesome for them. They've got cash flow coming in. What quantitative easing is, it's the central bank in the UK, it would be the Bank of England. It would be buying these bonds. It's a forced sale, buying these bonds off the banks. Now, all of a sudden, those banks have cash. They no longer have these bonds, but they were benefiting from those bonds because they were getting a nice interest payment. So all of a sudden, what do they go and do? They go and buy more bonds. And when they go out onto the market and go and buy more bonds, well, interest rates decline. As interest rates decline, because the more demand there is for bonds, interest rates fall. It's kind of an inverse relationship. So there's more demand for bonds, interest rates fall. If interest rates fall, consumers are now incentivized to borrow. So they start borrowing more. And so quantitative easing is effectively the forced sale of assets off banks. Now the banks are left with cash, so they're going to then go and buy more assets. And what that does is it pumps up asset prices and drops interest rates. And so the world in which we live in today, unfortunately, we see asset prices rising, we see real estate rising, we see stocks rising. This is artificial. It's a result of intervention. What is interesting is that money in its base level is meant to serve three functions. It's meant to be a store of value. It's meant to store our value over time. A medium of exchange. We should be able to exchange it back and forth to buy goods. And finally, a unit of account. It should be able to enable us to measure things in the economy. So if you go into a grocery store and you see all the prices in pounds, that is because it's your unit of account. You're accounting for all of your prices in pounds. Let's forget about those second two for a second and focus on store of value. Money is meant to serve as a store of value. Now, if we go back to our example earlier where we were discussing how humanity has always strived to get more for less, prices should be falling over time, which means that if we just simply saved our money in the currency, well, life would get easier. Our cost of living would decline. The world would have more capacity to show up in the world how we want to. That is amazing. But unfortunately, because of intervention, because of the suppression of interest rates incentivizing borrowing, because of our decimation of purchasing power where our cost of living is rising, people are no longer incentivized to save in the currency. So what are they going to do? Well, people aren't just going to keep their money in the currency because they're seeing that their purchasing power is declining. So they're either going to consume, so decimating our natural environment, or they're going to invest. So all of a sudden, all of this capital that would just be sitting in the currency floods into assets. So real estate prices skyrocket, farmland skyrockets. And a lot of these things, they're skyrocketing not because people are using them to put a roof over their heads, not because they're using the farmland to grow crops and add value to society. They're using them simply to store value. So now real estate and farmland and stocks, they've all just become forms of money. That's all people are using them for. And so where I live in a small ski town in Whistler, in Canada. Oh, sorry, I live in a small ski town in Canada called Whistler, and 61% of houses are empty. They're empty because people are not using them as houses. They're using them as money. They're using them to store value because the money is a poor store of value. In London, there's 100,000 homes empty. There's a freaking rental crisis, and people are struggling to find homes, and there are 100,000 homes empty because our money does not store value. So people are using houses to store value. So if you think about it, if we had a monetary system with a fixed supply of units, no one could increase the amount of units. All of a sudden, as humanity advanced, prices would start falling. Well, that would incentivize us to simply save in the currency. So all of this money that's stored in houses, all of this money that's stored in bonds, in equities, stocks, farmland, you name it, would flood out of these assets and back into the currency because it'd be favorable to once again save in the currency. We should be able to save. We shouldn't have to invest. Investing takes risk. Saving does not. Saving is just saving in the currency. It's holding our purchasing power in currency.
It's interesting, as you're saying there in the UK, I don't know if it's the same in Canada, but what you're talking about then there's a renting crisis, and the hatred towards landlords is unbelievable in this country. I speak to people every day in the comment section of all the videos I create, and they always blame the big companies is one, and the other one is landlords in the UK. And what nobody really thinks about is what you just described really well there, is the fact that these people aren't trying to be greedy and overtake the world and take over the land. They're just trying to find a way of protecting themselves from inflation. And like you said earlier, houses are artificially inflated because of the money printing and more money being into circulation. So therefore the houses go up in value. My house that I'm in right now isn't any better than it was when I bought it, but it's gone up in value. And the only reason that I can see that that's happened is because there's more money chasing for the same amount of goods and services and houses, therefore artificially pushing it up. So you just touched on a point then, and I think that's going to lead us nicely into Bitcoin, is you've laid out a really good kind of summary for the broken money and the current money that we use, and the fact that debt is potentially the biggest cause of this issue. The fact that we can create money through quantitative easing, through fractional reserve banking. Banks can just create money, central banks can create money, and rather than actually solving a problem with money, they can just put more money into supply, therefore pushing prices up. There's a term that is used in the Bitcoin circles that I think a lot of people might not really discuss often that aren't into Bitcoin. It's this idea of fiat money. Are you able to describe what fiat money is? And I think we can shimmy into Bitcoin.
For sure. And I'll make up one quick point. You were talking about kind of this idea that society, unfortunately, just has a hatred towards kind of business, towards capitalism, towards corporations, towards
Mm.
landlords. And the reality is back in the 1980s, if you had looked up the definition of inflation in the dictionary, it would say inflation is a result of an increase in monetary units causing prices to rise. So it's showing you the actual lever. There's an increase in monetary units because the government is printing money that's causing prices to rise. Because if more monetary units are chasing the same amount of goods, well, prices have to rise.
Mhm.
As of the 1980s, the government changed the definition of inflation in the dictionary. They changed the definition of inflation to inflation is a rise in prices. And by saying that, it doesn't give any insight into
Mhm.
why inflation is happening.
It's
So
out
that
of our
allows
control.
it's out of our control. And
Yeah.
so what you hear is people like Biden coming in and saying, our number one goal is to fight the beast that is inflation. And we're going to do that through the Inflation Reduction Act and print $5 trillion. It doesn't work like you can't print money to
Yeah.
break down inflation. It does not work. And so there's this idea that inflation is a result of capitalism. It's greedy
Mm.
corporations. That's not true. In a free market, when you have competition, what ends up happening is prices fall. Because in order to be able to outcompete your competitor, you have to either increase the quality of your goods or you have to drop prices. And so in a free market, prices fall over time. They do not rise. And on top of that, if someone is offering you a rental property, they're adding value to society because maybe you're not in a position to be able to buy yet. But if someone is offering you a rental property, then they've been able to save to the point where they've been able to purchase a house and they've been able to rent to you. If they are charging above and beyond rent, like beyond the market pricing, you're not going to rent from them. You're going to rent from someone else. Their prices are going to fall. It's competition again. In a free market, value is being offered because if you were not offering value, money would not flow towards you. And so this is something that's really important is we have a misguided belief that capitalism and these greedy corporations are causing inflation. They've got nothing to do with inflation. Inflation is purely a monetary phenomenon. It is a result of money printing. And so
Mm.
back to the question around kind of money and fiat money. So fiat money, well, traditionally, I should say, before fiat money, money typically used to be backed by something, backed by gold. That is what provided its value. That's what provided its stability. If a nation wanted to print more money, well, it had to obtain more gold. It had to maintain a certain amount of reserves in gold, and that's what maintained its value. And then we went down into the world of fiat money. Fiat is when we drop that backing, and now money's value is a result of the government saying you have to use this money. Now, what is interesting is in kind of the economic fields, there's something called Gresham's law. Gresham's law is that bad money drives out good. It is that when there are legal tender laws that say you have to use this money. In the UK, you've got legal tender laws saying you have to use the Great British Pound. In Canada, we've got the Canadian dollar. In the US, you've got the US dollar. And those legal tender laws mean that if you're a small business, if someone comes to you and says, hey, I want to spend my Great British Pounds, you can't say no. You have to accept them. So over time, because people can spend the bad money drives out the good money. In a free market, it's the inverse that's true. There's something called Thier's law. And Thier's law is good money drives out bad. Because if you think about it, if you're a small business and it was a free market, you could accept whatever money you wanted. You're not going to accept the poor quality Great British Pound that's losing value over time. Instead, you're going to say, hey, I want gold, or I want Bitcoin, or I want something that is shown over time to preserve my purchasing power. And so in time, people stop using the poor form of money like the British pound and then trend towards the good quality form of money. So the moment we actually went to a free market in money, you would see all of these fiat currencies break down. Because why would people use them? People don't want to use
Mm.
something that is losing its purchasing power. And so that's kind of the definition of inflation, or sorry, definition of fiat money. Fiat, over time, with our money is transformed, and we're at that point where money is no longer backed by anything other than the government saying you have to use that money. And that means that governments can print more money to no end. And it's resulting in inflation, degradation of purchasing power, increasing prices, you name it.
Why why gold? Why does gold or did gold make good money?
So gold had some form of scarcity. Because if you think about it, when you have something that is more scarce than anything else around it, then all of a sudden you can protect your purchasing power in that thing. It cannot be, the supply of that thing cannot be inflated. So gold's what's called stock to flow ratio. So it's like how much stock is there and how much new flow or issuance is being created every single year is something around like 2 to 3%. So each year, gold miners mine around 2 to 3% of the total supply of gold. So that's kind of gold's inflation rate. When you're looking at things like copper, or you're looking at iron or a lot of these other natural resources, if I remember correctly, I think silver, and I could be wrong on this, so don't quote me, I think silver is something like 9% or 10%. You're looking at like copper, you're looking at like 15, 20%. So the greater that flow, or the greater that new issuance of whatever it is that you're saving in, the more that devalues your purchasing power over time. Because if you think about it, the more monetary units chasing the same amount of goods means that prices rise. So if you've got something with a fixed supply or a very low issuance, then all of a sudden, if you've got more demand for that thing, then because it's got less issuance than whatever it is that you're purchasing, food, supplies, you name it, then all of a sudden your purchasing power increases over time. And so gold was used for thousands of years because it was the scarcest thing that was available to us. Everybody trended towards the scarcest thing. The challenge is that when people started using gold, because gold is physical in nature, or you either had to store it under your bed, which is a bit of a hassle, it could be seized, it could be stolen, or if you were trying to save large sums of money, if you're a wealthy individual and you didn't have room to store it under your bed, well, you stored it in a centralized entity, a bank, a holding company, you name it. Now, the problem with storing it in a centralized entity is that that centralized entity recognized over time that, hey, all of these people are storing their gold with us, and we're issuing these receipts saying you've got this gold. And what they started doing is they started to create a fractional system. They started to lend out gold without telling the other individuals who had deposited their gold. So we created the same system we have today, where these banks, these holding companies, had a fraction of their reserves kind of in custody. And so that poses a problem. If everyone came to withdraw their gold, then they would default. They would be insolvent because they couldn't support all of the liabilities, given that they have lent out more. They've lent out more gold than they have in reserves to whatever it is that they owe from deposits.
So, famously in the US, 1971, people left. The government left the gold standard, meaning that the dollars did not equate to gold in any way, shape, or form. In the UK, I think it was in the 30s. It happened, mid 30s. What was the breaking point? What was the decision making process for that? Was it what you just described then, the beginning of fractional reserve banking, whereby they went, well, we've lent out so much money versus how much gold we have now. Why don't we just lose the gold?
In the US, to be more specific, it was actually because if a government is on a gold-backed system where you've got the currency backed by a large reserve of gold, well, the problem is if you want to go and fund wars, you're kind of restricted. Because if you don't have support from the populace and you're not increasing taxes and you're not generating revenue through other means, then all of a sudden you cannot fund war. And so what was happening around the 1970s? Well, we were in the Vietnam War. The US was in the Vietnam War, and they wanted to continue funding the Vietnam War, but they couldn't do that without breaking the gold peg. And so they broke the gold peg to be able to fund war. And if you actually look back throughout history, this has happened nearly every single time. What led to the breakdown of the UK leaving the gold standard was because it actually wanted to fund World War One, and after World War One, it didn't have support from the populace. It didn't have support from the populace, so it borrowed gold from the Federal Reserve in the US to give the impression that it had the gold when it didn't, and people started to catch on to this. And so over time, many times we've lost this peg to gold as a result of war. Governments have wanted to be able to fund war. They haven't had support from the populace. They haven't had the capital to do so. So they start basically printing more money at the expense of the currency holders. And that results again in inflation.
Okay. So we've established why money is broken and how it's broken and what fiat money is. Now might be a good time to introduce Bitcoin. And I think it'd be really good for everybody listening and me to break down Bitcoin to its basics, because you can go hours and hours into the subject. Who created Bitcoin? When did it start? And as a kind of bird's eye view, what is it?
So I would even start, and this is kind of how I've approached it in my book, The Hidden Cost of Money, which is, let's just step back for a second and say, ignore that Bitcoin even exists. And I urge anyone listening to this, if you have an aversion to Bitcoin, just follow my thought train for a second and try to push aside anything that's kind of coming up. Now, the first thing we've got to ask ourselves is, okay, we know the issues with money. At the moment, money is held by a centralized entity, and it could be printed to no end. And we're recognizing that, hey, if we have something with maybe more scarcity, then our purchasing power will increase over time, so prices will fall. So what do we need? What are the characteristics of money that are needed to be able to maybe realign the incentives in society? So we've got to ask ourselves that question. Well, first off, it needs to have scarcity, as I just mentioned. It has to have a finite supply, because if you have a finite supply, first off, that means that as individuals, as we create more value for society, as innovation and technology advances, then prices should fall. So life gets easier over time. At the very start of this conversation, we discussed this idea that there's a misalignment to reality. If we have a scarcity of money, all of a sudden we start to realign with reality. We realign in that prices fall, we can recognize these advancements in technologies. That's the first thing, we need scarcity. Second off, we need to remove centralized entities. We need to remove centralized entities because it is proven that unfortunately people are self-interested. If a politician wants to buy votes, he's going to say, we're going to print more money, we're going to stimulate the economy, we're going to give you guys money, we're going to give you guys paychecks to be able to support your families, we're going to give you food, we're going to support this industry, we're going to bail out these jobs. So we need to be able to have politicians, not only if they want to be we need to restrict the ability for self-interest, and we have to maximize the ability for value creation. So what that means is that in order for a politician to offer value to society, it has bounds to it. It cannot just print money at the expense of currency holders. So we need a currency that is decentralized. Decentralized and it's distributing that trust across multiple mechanisms. Thirdly, we need a currency that is permissionless. At the moment, we talked about this idea that money is a medium of expression. It's how we express to the world what it is that we value. If I want to go and spend my money in a certain sector of the economy, I should be able to go spend my money in that sector of the economy. If the government is stopping me from doing so, or the government is propping up artificial sectors of the economy, then it's breaking down my ability to express myself. So a permissionless money means that I do not need permission to spend my money. I can spend my money where I see fit. In Canada, we had the trucker rallies over the pandemic. And regardless of whether or not you agree with the trucker rallies, what ended up happening is protesters protesting legitimately, you're allowed to protest and voice your opinion, had their bank accounts frozen. That's insane. Their bank accounts frozen so they couldn't spend money, they couldn't survive, they couldn't eat. And so you need something that's permissionless. That means that if you have a dictatorial government, authoritarian government, all of a sudden they cannot freeze your ability to spend money where you see fit. That also means that if they're not offering value, then money does not flow towards that government, they wither away, and another government rises up. So that means you're forcing a free market. You're forcing governments and nation states to actually compete against one another. If one nation state is not offering value to society and another nation state is, then over time, capital will flow towards the nation state that is, that then incentivizes that government that isn't to offer value to society, to start listening to its populace. So these kind of three things: we need scarcity in the monetary supply, we need a decentralized money, so we're not relying on central issuers, and we also need something that's permissionless so that we don't need permission to be able to use our money. That would make a pretty amazing money. That would allow us to be able to move forward as a society in a way that allows value and competition to rise up. And so when we think about Bitcoin, well, what is Bitcoin? Bitcoin was created by a guy called Satoshi Nakamoto. And what's fascinating is I think right now he is something like the 60th wealthiest person in the world, and nobody knows who he is. He's anonymous. And people have theories about who he is, but there's no clear evidence as to who he is. He was just an anonymous individual that released this money to society and very quickly passed it off onto the community. And it has grown since then. It was released in 2009, and it has grown to now being, if I remember correctly, it's about the 13th most valuable asset in the world, in line with nation states, in line with some of the biggest the biggest corporations in the world. And this thing was created in anonymity. No one knows who the founder was. It's a pretty amazing story. And it was handed over to the community. And now Bitcoin is this decentralized digital money. There will only ever be 21 million. So we have that scarcity factor. And it is decentralized in that any individual globally can choose to run what's called a node. And a node is basically a record of all the transactions that have ever taken place. What that means is if you as an individual say, okay, you know what? I'm going to take this Bitcoin and I'm going to say that I've got 100 million Bitcoin over here. Well, your node may say you have 100 million Bitcoin, but because there's 100 other thousand nodes globally that say you don't have 100 million Bitcoin, well, it's on consensus and you cannot change it. So there's no individual that can co-opt Bitcoin and control it to their benefit. And then finally, it's permissionless. Bitcoin is what's called peer-to-peer. So I can transact with you, even though you're in the UK, just as if we'd just done a cash transaction. That is profound. That means that all of a sudden people are able to transact globally. So it removes all of these intermediaries from like big corporations that are taking a huge cut of our ability to transact. But also it removes those corporations and those governments from preventing us to spend our money where we see fit. The analogy I gave at the start of China was if you're an individual and you want to support your family and you want to protect your purchasing power, but the Chinese government is saying, hey, you're not allowed to invest your money overseas. Well, all of a sudden, with something like Bitcoin, they can't stop you from doing that. You can then direct your capital where you see fit because Bitcoin is effectively a peer-to-peer transaction without any intermediaries, but you can do it cross borders, you can do it anywhere in the world. That is profound. And then the other final thing that I'll just mention is when it comes to Bitcoin or when it comes to gold, the issue we had with gold is that because it was tangible, it was physical in nature, you had to custody it. If you custodied it, well, you could keep it under the bed, but that was prone to theft. It was prone to seizure. Or you could hold it in a centralized entity, but then we go back to all those problems around what happens if the centralized entity issues more monetary units than in reserves? What happens if that centralized entity lends out my gold without my permission? When it comes to Bitcoin, what is so profound about Bitcoin is you can take custody of your Bitcoin yourself. So if you remember 12 to 24 words, it's effectively your password to access your Bitcoin. So what is profound about that is that if I'm an individual and I'm living under an authoritarian, totalitarian, controlling environment, and I don't believe in my government, I can walk across that border stark naked. And I can walk across that border with all of my wealth stored in my head. No one has to know that you have your wealth stored in your head. That is like unlike any other currency, any other form of value we've ever had ever in history. And so what that means is it forces a free market. Value flows to where value is being created because it becomes very hard for governments to be able to seize that value. And we've never had anything like this. Every other asset in history has either been physical, property can be seized very easily. The government can come and knock on your door and evict you very quickly if they wanted to. Any other asset, commodities, silver, diamonds, physical nature can be seized very easily, or it has to be stored somewhere. All digital assets, if you're holding bonds, if you're holding stocks, if you're holding cash in the bank, all of these things are held by a third party. That third party, again, given that it's under jurisdiction, the government can seize those assets. It can freeze those assets very easily. In 2014, Greece basically defaulted and Greece went under as a country. What do? They froze everyone's bank accounts and they took 50% of everyone's deposits to be able to bail out the banks, bail out the government. That same thing can happen in the UK. That same thing can happen in Canada, in the US. And those are based on what are called bank bail-in laws, where they bail in customers' deposits to bail out those banks. So that is possible to happen in these developed countries. But with Bitcoin, that is not possible. So all of a sudden, we have something that's truly scarce. We have something that is decentralized. We have something that has distributed that trust that is permissionless. And not only that, you can take custody of it. So when you think about Bitcoin under this lens, forget about all of the other stuff that people talk about. Bitcoin under this lens fixes our monetary system in that it forces a free market. If a government is not offering value, then it will slowly wither away, and a government that is offering value will rise up. What is also fascinating is when we think about war. Earlier, we discussed this idea that the Vietnam War caused the US to kind of drop the gold standard because it wanted to fund war. That means that governments can fund war without support from the populace. Under a Bitcoin standard, that is not the same. It's not possible to do so. If you want to go and fund war, well, you've got to first either have support from the populace and you've got to save, or if you were to go do so without support from the populace, you're going to quickly lose purchasing power because the populace is not going to pay taxes and that government is going to break down. They're not going to be able to fund that war. But not only that is, even if you had support from the populace, you've done your saving, you've done your due diligence, you now go to war, and all of a sudden, hey, we're diminishing our savings pretty quickly. We don't have the resources to continue fighting this war. In today's kind of war society, we just print more money. Under this society, they either have to basically just kind of give in or back off. And that means that wars would be a hell of a lot shorter. There'll be a lot less casualty because it's forcing value creation. So I think that ultimately Bitcoin, when you look at it from a monetary lens, not just a speculative so-called asset that's just emerged out of the ether, Bitcoin is a new monetary paradigm that forces a free market. It forces value creation. And I think that is profound. And the last final point that I'll quickly make is that a lot of people say, oh, well, under a free market, how are we going to support the people on the bottom rung of society that are struggling? How are we going to stimulate the economy in times when times are tough? Now, what is interesting is that today, homelessness is increasing massively. People are struggling. The cost of living is so expensive that we're seeing widening wealth inequality, more and more intervention. People are not being supported in the current system. And under a free market system such as Bitcoin, what ends up happening is because you're allowing prices to fall, because you're allowing innovations to take place, and you've got a fixed unit of currency, all of a sudden our cost of living gets cheaper over time. If our cost of living is getting cheaper over time, then it's becoming easier to survive. If it's becoming easier to survive, then those on the bottom rung of society over time have a greater chance of being able to get out of their predicament. Not only that, but if money is not flooding into assets such as real estate, then we're not going to see the same appreciation in house prices. I would actually argue that house prices would drop around 80% plus if houses were to be used purely as their utility value, putting a roof over their heads. There's always going to be desirable places to live where house prices are a little more, but in general, houses would no longer be used as an asset to store value. Instead, they'd be purely used for their utility value if we could just save in the currency. So house prices would be a hell of a lot cheaper. It becomes easier for people to put a roof over their heads. And so I think that when we start thinking about a world under a free market, life is a hell of a lot easier for people. It's easier to get ahead. And lastly, at the start, I mentioned this idea of kind of parents. Parents today, unfortunately, because of cost of living, means they're having to work more. In Canada, from the 1970s to today, we've seen a doubling of dual earner households. So two parents having to go out and work, and a halving of single earner households. So one person being able to support the family. That means that parents having to go out and work because they can't afford to not do so. And so if parents are working more, then they're spending less time with their kids' emotional needs are not being met. We're having immense drug use, suicide, depression, anxiety, obesity. All of these things are coping mechanisms because kids are not having their emotional needs met. In a world where parents saw their cost of living falling, where life starts to get easier, they have greater capacity to show up and meet their kids' emotional needs. So I'd be willing to bet under such a world, we would see a drop in depression, anxiety, ADHD, like many of these coping mechanisms that are a result of kids not having their emotional needs met.
So Bitcoin essentially forces the free market upon everything, just as we talked about how money touches pretty much everything in society, from parents to housing to even war. It even puts free market into war to actually incentivize people to do as little of it as possible, if not none of it at all. Rather than now, war is so profitable. The industrial complex in the US, whereby war is the thing that creates so much money for so many people that are close to that, close to the manufacturers of the weapons. So Bitcoin could almost flip down its head and make it and disincentivize people to do that, because actually the money is sound.
Absolutely. Absolutely. And to that point quickly, which is every other asset, given that we've spoken about, every other asset can either be seized because it is tangible, physical in nature, or is held by a third party. That environment means that a lot of leaders rule by force. A lot of leaders rule by coercion. Under a Bitcoin standard, under a world where we're operating on Bitcoin, the inverse is true. Because Bitcoin, I don't know if you can hear the dog barking upstairs, hopefully not. Because Bitcoin can be self-custodied, I can take custody digitally of the Bitcoin myself. All of a sudden, that is profound. Because each and individual person in society can take custody of their Bitcoin, it becomes almost impossible for the government to seize large-scale seizure of Bitcoin. And so that means that if the only way the government can obtain Bitcoin is through the willful, voluntary handover of Bitcoin, then that means that ultimately the only way for government to obtain Bitcoin is to offer value. They have to listen to their populace. They have to say, okay, what is it that you guys actually want? And if the populace say, we don't want war, they'll be like, okay, well, we're not going to go and fund war. Well, we want a healthcare system that actually supports us. Okay, we've got to think about, given that we're limited in finances, we've got to think about how do we create a healthcare that actually supports people? Well, maybe instead of treating the healthcare system as treating symptoms, why don't we try and treat the root cause, which is we have an obesity epidemic and we have people that are incredibly unhealthy metabolically. So why don't we start teaching about proper nutrition in schools? Why don't we think about long-term reducing the expenditure on healthcare, but actually increasing the health of our society, not just treating symptoms? And so by forcing a free market, you force value creation, you force competition, you force governments to listen to their populace, you actually increase the health of society. You stop treating symptoms. You stop doing what we're doing at the moment in politics, which is we're constantly trying to buy votes by promising things that we can't really kind of hold up, or even if we can hold them up and say, okay, you know what, I'm going to buy this and I'm going to buy that and I'm going to stimulate the economy. It's at the detriment of society. It's at the detriment of currency holders. It's at the detriment of one part of society.
So by fixing the money, you are essentially causing everybody to think long term. You are pushing out their horizon of what they think about what to do with their money rather than spending it now. Because the biggest challenge that I have, I talk about personal finance on a daily basis to people now. The hardest thing for me to try and convince people to do is to think long term. They are always, the whole YOLO attitude of you only live once. I don't know what's going to happen in the future, so I'm going to spend my money now. They're not internalizing as to why they're doing that, but it's because of that very reason, because they don't feel like they can actually. They know that their money is getting worth less over time. So they think, what's the point? I'm not going to save money, because most people don't understand the idea of investing. The layman isn't out there spending hours and hours learning about how to invest, the stock market, Bitcoin, property. They're just thinking, well, I want to go on holiday next year, and I know my money's going to be worth less in a couple of years' time because COVID just happened, and all of a sudden everything's really, really expensive. So their time preference is really high. It's high short term, isn't it? I always get those two max swapped around.
Yep, that's right.
High is now, low is in the future. So the time preference is really high, and all they're thinking about is the next couple of years maximum. And I always try to tell people, like, once you start understanding this idea of buying assets, and unfortunately it's looking through the fiat lens of broken money, but if you put your money into things that are going to increase in value over time, all of a sudden their time horizon, their time preference it gets lower, and they start thinking out into the future. So I think you're absolutely right, and on paper that makes perfect sense, and hopefully people listening to this can internalize that. Is that once you fix the money, and that your money actually increases in value over time, or inversely things actually just get cheaper over time, like they should do because of efficiencies and technology, you are going to think more long term. One thing that people push back to all the time, and I don't often talk to people about Bitcoin, but when I do, I get a kind of multitude of different responses that are often negative because of some sort of touch point they've had with Bitcoin, whether it's hearing about scams, or Silk Road money, or drug dealers. This is magic internet money. Or you try and explain to them that Bitcoin is a ledger. It is literally just a bunch of computers linked together that all come to a consensus of this is the truth. It's quite hard for somebody who thinks through the lens of Great British pounds or Canadian dollars to kind of switch how they view it. So it's easy to just kind of push to the side and go, no, well, I'm never going to spend Bitcoin because Bitcoin is never going to become the money I spend down at the local supermarket. How would you, at the basic level, explain what it is? Because it's not physical, even though it's symbolized by a coin that's got a B on it, and everyone goes, oh, is that Bitcoin? Well, how do I get one of those coins? People who know nothing about Bitcoin really do potentially think that it could be a physical thing. How would you explain that to somebody other than, I mean, I know I've just explained it through the lens of a ledger, and it is literally just, I did this, you did this. But how would you explain to somebody who's never even heard of the word Bitcoin before?
For sure. So when we think about value, there's effectively two types of value in society. You either have tokens, physical tokens. Currency is a token. If I give you this coin, well, I can't go spend that coin somewhere else because I've given it to you. It's a physical item. The problem with tokens digitally is that if I give you this coin digitally, who's to say I didn't Control C or copy that coin, and then I go and spend that coin somewhere else? So then we have a problem. Tokens work in the physical realm. We can hand over currency units. I can hand over my brick of gold. I can hand over my house to you. And that means that I cannot double spend. I cannot go spend that thing that I've handed over to you again, given I've handed it over in the physical realm. So how do we do that in the digital realm? Well, in the digital realm, we track value through ledgers. And so a ledger has historically been kind of been dealt with in a centralized manner. So your bank account, when you're dealing with all of the money that's in your, not in your physical wallet, but in your digital wallet, they're dealing with a ledger. They have effectively a giant spreadsheet that says, Seb has $1,000 in his bank account. Brian has $2,000 in his bank account. Jane has $500 in her bank account. And each time I go and send money to someone or I receive money, the ledger is updated. So that ledger is basically just a record of transactions. And what that means is that if I go and spend money from my bank account and that ledger is updated, I cannot go re-spend that money again. Just like that example that I was giving with the token. If I go and give you my house, I can't go give that house to someone else. I've already given away my house. The same thing on a ledger. That's how we got around what's called this double spend problem. And so Bitcoin is a distributed ledger. The problem with a centralized ledger is if your bank manager decides, hey, Brian is going and buying Bitcoin, we're going to freeze his accounts. He's not allowed to use his accounts. You're not going to be able to use your accounts. So now all of a sudden you're stuck. That centralized ledger has impeded you from being able to show up and express yourself where you see fit. Going back to that point about what are the characteristics of money that we want? We want a permissionless money. I want to be able to spend my money without permission. Well, Bitcoin gets over this through distributing that ledger. Anybody in the world can run a Bitcoin node. So there's hundreds of thousands of people that are running what's called a Bitcoin node, and it's effectively just a copy of this ledger. And so when I go and spend my money, one person in this worldwide web of nodes can say, hey, I don't agree with this person spending this money. But if 99,000 other nodes say, yeah, that's fine, well, it doesn't matter what that one person thinks. And so ultimately, Bitcoin distributes this ledger globally so that money is able to move and flow freely where people want it to. And it also prevents people from double spending that money. So Bitcoin is a distributed ledger. And it's profound to think about it. But effectively, when you go to spend money, you're not actually passing anything over digitally. You're not saying, hey, here's this digital thing. What you're actually doing is you as an individual, if you own Bitcoin, you just have the right to update your Bitcoin on this ledger. And so if you go to spend your Bitcoin, what you're actually doing is saying, hey, I'm deducting Bitcoin from here and I'm adding it to your little area on the ledger. That's all that's happening. It's just a simple digital ledger.
That's a great way to think about it. So, like you said earlier, there's only ever going to be 21 million Bitcoin ever in existence. And one concept that has been adopted from gold would be this idea of mining. How does one go about mining a Bitcoin? What's that process?
So when it comes to Bitcoin, the problem that we have in creating a decentralized monetary system or a decentralized currency is that historically, if you look at, so let's take your credit card, for instance. When you go and purchase something at the grocery store on your credit card, if you look at your credit card statement, you've got two areas of your credit card statement. You have the pending transactions and the posted transactions. Pending meaning they're waiting for kind of approval, but they have gone through. The person has received the money, it has gone through, and then posted, okay, that's a finalized transaction. If you want to reverse that, we have to go and issue a refund. And what that means is if we want to do that in Bitcoin, well, we have to take this centralized entity such as Visa or MasterCard who is taking pending transactions and kind of processing them so that they're posted. We have to take that and distribute that, because if there's one entity doing that, well, then you have a permissioned system. It's not permissionless. You have one entity who can control whether or not that transaction is going to go through or not. And so what Bitcoin has done has introduced these things called miners. And anybody can be a miner. If you want to be a miner, you can be a miner. You can use your laptop to mine Bitcoin if you want. It's not going to be very effective because technology has advanced quite a bit. But what it basically means is that if you are a miner, you are taking transactions that are pending and they sit in what's called the memory pool. It's the memory of all of these transactions that are sitting there pending, waiting to be processed. You're taking these transactions, you're processing them, and they're being appended or added to the blockchain. And you guys have probably heard of blockchain. We don't need to go too deep, but we're basically taking pending transactions and we're processing them. Now, the way miners do that is they compete against each other. And I'm going to give not necessarily 100% accurate explanation, but it suffices for what we're talking about. You can think about these miners effectively solving a math equation. And the first miner to solve the math equation is the one who allows his transactions to go from pending to processed. And in return for solving that math equation, he is rewarded. He gets all of the transaction fees. So at the moment, when you transact through credit card, Visa, MasterCard, and all the intermediaries, they get the transaction fees. When you purchase $100 worth of goods at the grocery store is not receiving $100. They typically, it's about 2 to 3%. So the transaction volume is in fees. So they're probably going to receive $97 or 97 pounds, and the grocery store is going to receive, the transaction processor is going to receive £3. And so in Bitcoin, the same thing. When you send Bitcoin, there's a transaction fee. That transaction fee is going to go to the miner. So the miner who successfully mines and solves that mathematical problem is rewarded with all the transaction fees. And so that's really important to note. That's what incentivizes the miners to mine Bitcoin. There's a little more to it than that, but we don't need to go too in depth because it's quite easy to lose people.
Yeah, no, I think that is definitely a great explanation. I've never actually heard it put that way of pending to finalize it. That's actually a really good way of thinking about it. So people tend to put all crypto. Unfortunately, that is the thing that's used for everything cryptocurrency or crypto asset related. Bitcoin was the original. I know there was sort of attempts at Bitcoin prior to, but Bitcoin was the first successful cryptographic currency, whatever you want to call it. Ever since then, there's been thousands, if not tens of thousands, of new ones. People think of Ethereum and Solana and all these other coins, Dogecoin, Elon Musk would talk about. So people hear all these words and they all just think about cryptocurrency. They put it all into the same basket. Are they all the same thing?
No. And so this is one thing that takes a long time to go down the rabbit hole of Bitcoin to recognize that there is Bitcoin and then there is crypto. And even for me, when I went into the space, I started investing in all of these other shiny tokens, these ones that are promising unbelievable returns. But when you start digging a little deeper, what you realize is that one, the innovation right here when it comes to cryptocurrency is that Bitcoin has been able to decentralize money. It's been able to remove money from state, create a permissionless, trustless, decentralized monetary system with true scarcity. So Bitcoin, if we can simply fix our monetary system, I truly believe we can resolve many of the challenges that we face in society because a lot of them stem from a broken monetary system. The cryptocurrency industry has piggybacked off Bitcoin and they've started to create thousands of other tokens. The majority of these tokens are effectively just taking Bitcoin and running their own little ideas and their own tweaks to the code base. And the problem with that is if you've got a centralized entity governing these tokens, people are going to invest in them. They're going to go up in price. And then these owners of these tokens are just going to unload their tokens onto the market, crash the price, and then walk away with your purchasing power. We've seen this happen thousands of times. And it's really sad to see. So the analogy that I'm going to quickly give is that like, if you think about the 2000 tech boom, when the internet came out, if you were a publicly traded company and you simply just made a website, put .com on the end of your name, your stock price went skyrocketing. This is effectively what is happening today is people are putting blockchain on the end of their freaking publicly traded company, and all of a sudden their publicly traded company is skyrocketing in price. And just because you put blockchain at the end of your company or you start using blockchain, that doesn't offer value to society. And so we're going to see I think Bitcoin is going to continue to climb into the future, just like the 2000 tech boom. Out of the thousands of companies that made a website, very few of them exist today. So I'm not going to say that there's zero value in the cryptocurrency space, but what I will say is the majority of them are going to go to zero because they're piggybacking off of the technology. The second thing I'll quickly say is that when you actually look at Bitcoin in comparison to a lot of the other cryptocurrencies, very few of them, it's something like 2% of all those other cryptocurrencies are actually trying to be a form of money. The rest of them, like Ethereum, is not trying to be a form of money. It's trying to create certain capabilities digitally, like smart contracts, be able to maybe take the insurance business, take the whole centralized insurance business and make it decentralized. Or you get things like Filecoin. Filecoin is taking Google Drive to make a decentralized Google Drive. So you're storing files in a decentralized manner as opposed to a centralized manner. And so what you realize is that many of these tokens, although they're deemed cryptocurrencies, it's a bit of a misnomer because many of them are not actually trying to be currencies. They're just trying to do something using blockchain or using blockchain in a way that maybe has not been used before. But I would still say that most of them are probably going to go to zero. And when you look at Bitcoin, there's some charts where you look at Bitcoin since inception, so since 2009, and then you see every other cryptocurrency since 2009. And you'll see in the short term, sometimes you get these cryptocurrencies that go nuts. They go up well and above beyond Bitcoin, but then they collapse down to zero. And so in the long term, Bitcoin has outcompeted every single other cryptocurrency, and it continues to do so. And so no one has even come close to outcompeting Bitcoin. So for me personally, we can try to innovate. We can try to take Bitcoin's code base and copy it and go and do something different. But for me, I think if we as a community, as a world, get behind something like Bitcoin and we're able to shift our monetary paradigm, our beliefs around money onto something like Bitcoin, I truly believe we can resolve a lot of the challenges that we face globally. And that's why I'm more focused on focusing my energy towards Bitcoin and advancing that because it benefits everyone globally than just trying to make a quick buck in all of these other cryptocurrencies.
All these cryptocurrencies that get the term, I believe, is pump and dump or rug pull of these cryptocurrencies are created by an individual or a company or a small group of coders that have manipulated Bitcoin's code to create something, to do something different. Is the reason that it gets pushed up so high and then drops to nothing and disappears because there are actually people making decisions behind those things? You know, you said earlier how Satoshi Nakamoto created it, and we don't know who he or she or they are. Is that important for the potential success for Bitcoin versus the other cryptocurrencies?
So many times why we're seeing these kind of rug pulls or these pump and dumps is if you issue a token and you say this token is 1 million units of this currency, and at the moment they're trading at $1. Now, out of those million units, they're not all available. 900,000 of those units, let's say they're with the founders of this currency. So you've basically got what's called an illiquid float. Illiquid meaning it doesn't flow very easily. It's not, people don't really have access to it. And so when you get a large amount of people, if you create a bunch of hype and all of a sudden they start buying in, you've created artificial scarcity. There's only 100,000 of these tokens out of the potential million. So price starts to skyrocket. And so when you restrict the float, or when you restrict the total volume of currency units for one of these currencies, you can create immense amounts of volatility very quickly. But then the problem with that is when it pumps up in price, these 900,000 units that the founders own, that the shareholders own, they just dump them onto the market. And that's where you see price rise, and then just collapse. And it's actually the same thing that FTX. So you guys may be familiar with Sam Bankman-Fried founded FTX, and he had something called the FTT token. The FTT token, he did the exact same thing. He had the FTT tokens that he had created on his balance sheet. He then restricted the supply. There was only a finite amount of FTT tokens in the market, and he owned like 80, 90% of those tokens. So all of a sudden, if you create hype and everyone comes and buys into this FTT token and it skyrockets in price, well, now he goes out to all of these banks and he says, hey, look, we've got billions and billions of dollars of this FTT token. That's not necessarily true. If you try to unload even 1/5 of those FTT tokens onto the market, it would collapse the market. And so he borrowed against basically fictional value. And that allowed FTX to grow and grow and grow to the behemoth that it was. And then it basically just completely decimated all of the investors, all of the depositors, you name it. But kind of to that point around Bitcoin, what I think is interesting around Bitcoin is that we are in a world where, because of fiat currencies losing their value, people are just trying to get what they can from society. They've got this very nihilistic attitude where, hey, I don't know how I'm ever going to be able to afford a house. I don't understand how I'm ever going to get ahead in life. So I'm just going to invest in this risky token that hopefully is going to 100x my money, because that's the only way that I'm ever going to be able to get by in life. And so people are pushed into risk because of our current monetary system. And that's really, really sad to see. When you look at something like Bitcoin, well, Bitcoin has been the best performing asset ever in history. It has annualized since inception, since 2009, something like 208% a year. That's not to say that it goes up 208% every single year. There have been years when it goes down 80%, and that's happened multiple times. But in the long run, it has on average gone up 208%. And so if you hold Bitcoin long term, then you're almost guaranteed. I'm not going to say guaranteed. You cannot guarantee anything. But if history is a predictor of the future, then you're going to do totally fine financially. And so back to your point about kind of money and behavior, what is so fascinating about Bitcoin is that it shifts how we think about the future. At the moment, our monetary system is incentivizing us to take risk, to go and pile into these sketchy assets, to hopefully try and make just enough of a return to exit and go and buy a house. Okay, I'm fine. Whereas when we think about Bitcoin, it flips everything on its head. We're incentivized to start thinking long term. Hey, if I just store my purchasing power in this thing called Bitcoin, as we see greater adoption of Bitcoin, as technology advances, efficiency and productivity increase, and prices start to fall, Bitcoin's price is going to increase. And so I'm going to be totally fine simply saving. I no longer have to take risk in going into a lot of these sketchy other assets, these small little rug pulls, these pump and dumps, you name it, just to try and get by. And so Bitcoin ultimately allows a society to go back to saving as opposed to investing, because we should be able to save. There's a big difference between saving and investing. Saving is not taking risk. Investing is taking risk. Our world today, we cannot save. You cannot save in the currency because your purchasing power is declining. We're pushed into risk. And so I think that's really important. We should be able to simply save because humanity is thriving. Advancement in technology is booming. Efficiency and productivity are increasing. We're just not realizing any of those benefits because of intervention.
When I talk to people about Bitcoin, quite often people will say, what's the number at which Bitcoin will get to when you're going to sell it? That's kind of the lens that people look through. It's you buy the Bitcoin for the Bitcoin to increase, to then sell the Bitcoin and then get your fiat money again, and then you can go and buy houses or whatever it is that you want to. Essentially, the lottery ticket that is Bitcoin. That's how a lot of people view it. For the average person, do you think? Would you say the way you put it then as a savings account rather than investing? Do you think the average person should treat Bitcoin as a savings account, and should you think of it as converting it back to whatever the local currency is in the future? Or do you think of it as saving it, holding it for the long term, and then doing something else with it?
Yeah, so the latter, which is the fact that today, the unit of account that most countries are using is their local currency. The unit of account you guys are using in the UK is the British pound. In Canada, it's Canadian dollar. And so what ends up happening is that many of us, look at the world through the lens of fiat currencies. So we price everything in fiat currencies. The world is a very bleak place when we price things in fiat currencies because our cost of living is so expensive and it's continually rising. House prices are continually rising. And so when we look at the world through the lens of fiat currencies, well, Bitcoin is just another asset that hopefully if I buy a little bit of Bitcoin with fiat currency, it goes up in value. I can then exchange it back to fiat currency and I've made my life just a little easier. When you actually flip the lens at which you view the world, so you start viewing the world through the lens of Bitcoin, the world is a very different place. Prices are falling in relation to Bitcoin. House prices are falling in relation to Bitcoin. Life is getting a hell of a lot easier in relation to Bitcoin. The longer time you've been in a Bitcoin, the easier life gets. And so what I'm always trying to urge people to do, I educate a lot about macroeconomics, finance, Bitcoin, and through much of the content that I create, it's about trying to flip people's lens at which they view the world. And so I save in Bitcoin because I genuinely believe that it is the safest asset that we can save in. It cannot be seized easily. It is decentralized. It is distributed globally. It is very hard to corrupt Bitcoin. Every other asset in history is either shown to have been corrupted, or it is very easy to be stolen, theft, seizure, you name it. And so I'm always trying to look at the world through the lens of Bitcoin. That's not to say that I'm never going to sell any Bitcoin, because what is money? Well, money is effectively we expend our time and energy to go and we expend time and energy, we go and work, and we're remunerated in the form of money. That money is a store of our time and energy so that we can expend that time and energy in the future to ease our life, to be able to buy security. And so when Bitcoin reaches certain prices, of course, I'm going to sell a bit of that Bitcoin in order to be able to ease my life. So I have a number. If Bitcoin goes up to a certain number that I have in mind, well, I'm going to sell a portion of my Bitcoin and I want to go and buy a little plot of land so I can have a cow and I can live more sustainably and live more sovereign or have more sovereignty. And so I still think about Bitcoin as a form of money. It still allows me to buy security, but my purchasing power is held in Bitcoin. My purchasing power is not held in fiat currency, and I use Bitcoin as a short-term asset. And so I think that's the difference in the way that we view the world.
Yeah, because I think a lot of people think even if they completely agree, internalize, and go, "Yes, I'm on board with Bitcoin," they go, "Well, I can't spend it anywhere." So yes, I can, have Bitcoin, but I can't go and spend it at the local supermarket. I can't buy a house in it. I can't buy a car in it. All the things that people need to survive and want in life, they can't spend a Bitcoin. I'm sure maybe at some point in the future, like El Salvador, you'll be able to spend Bitcoin as a potential currency within the country. But let's say it's not. The biggest challenge is trying to convince people to treat it as a savings account.
Yeah,
And let's say they are.
absolutely.
Let's say people do think, okay, cool, I understand that. That's now my savings account. I'm not going to put money in this bank that are paying me absolutely nothing. In fact, it's losing value due to inflation because of the money printing. I want to hold Bitcoin. How do people store Bitcoin? You mentioned earlier cold storage. What are the different ways that people can do it, and what is the best way?
For sure. And to that point quickly, there are more and more tools available these days for people to be able to live on a Bitcoin standard, to be able to spend Bitcoin, and the person who's receiving the funds are receiving fiat currency. So in Canada, we have a company called ShakePay. It services something like 5 or 6 million Canadians. Like, it's not small. There's only 40 million Canadians. So it services a decent chunk of Canadians.
Wow.
And ShakePay allows you to have Bitcoin in your wallet. And when you go and spend in the grocery store, they're receiving Canadian dollars, and ShakePay is doing that conversion for you. So people can start living through Bitcoin. When you can travel, there's certain debit cards that allow you to spend your Bitcoin. So as technology advances, we're going to have greater capacity for us to be able to spend Bitcoin as Bitcoiners and use it as our everyday currency. It doesn't matter what the other person is receiving; they can receive whatever they want. But what means is that we are living through a Bitcoin standard. And so when it comes to actually taking custody of your Bitcoin, first off, I would say to anyone who's listening to this, if you go and buy Bitcoin and you go and hold it on the exchange, well, you open yourself up to risk. We're back to square one when it comes to money. It's being held by a centralized entity. If that centralized entity decides they don't want you spending your Bitcoin, you're not going to be able to spend your Bitcoin. Or if that centralized entity goes insolvent, goes bankrupt, you're not going to be able to spend your Bitcoin. You're probably going to lose your Bitcoin. It also means that if your jurisdiction at which you live in becomes unfavorable to Bitcoin, then it may be able to seize your Bitcoin. And so as a Bitcoiner, as anyone who is down the rabbit hole of Bitcoin, we always very much push for taking custody of your Bitcoin. Taking custody of your Bitcoin means taking that Bitcoin off the exchanges and holding it yourself. Now, typically, if you've only got a small amount, stuff that, okay, if I were to lose this, it doesn't matter. It's like the maximum amount you would store in your wallet. If you were to lose it, it's not going to massively impact your life. It's going to be upsetting, but it's not going to impact your life. You can have those in what's called a hot wallet. And a hot wallet, you can just download on your phone and you can take self-custody and store that Bitcoin in your hot wallet. And you can think of, I think there's one called like Moon Wallet. Moon Wallet allows you to do so. And you're taking self-custody of your Bitcoin. Now, the moment you start to save more than you'd be willing to lose, like in the event that someone was to steal your phone or something was to happen to the point where you were to lose that money, if you're storing more than that, well, now you've got to start thinking about a cold wallet. When I should say quickly, hot wallet refers to if it's an internet connected device, if it's stored on your laptop, if it's stored on your phone, it's internet connected, which means it's open to threats of hacking, vulnerability, it's hot. Cold wallet, you can actually go buy specific devices such as Trezors and cold cards, and you can buy these things online. They range from about, I would say, in pounds, what is it, maybe like £40 up to £200, depending if you want really high-end ones. And these devices are cold. They're never connected to the internet. And what you do is once you initialize them, which is a very simple process, you can effectively store your Bitcoin on these devices through your laptop. You plug it in, you take your Bitcoin off the exchange and you receive it to your cold storage device. And all of a sudden, you are now in custody of your Bitcoin. If something was to happen to your laptop, doesn't matter. If something was to happen to the device, you also have a backup. But I don't want to go too in depth because I don't want to lose people. But long story short, like my good friend Daz and another big Bitcoin kind of idol, Greg Foss, we founded a company about 4 or 5 years ago called Looking Glass Education. And Looking Glass Education talks about kind of, we speak to the layperson, removing a lot of the jargon, and we offer courses, we offer deep dives, and it's all free and accessible. And you can find it just at lookingglasseducation.com. But what we realized about a year and a half ago was that a lot of people, they struggle with the custody component. It is intimidating, it is daunting. And so we want to try and make that as simple as possible. And so if anyone listening to this is kind of, I don't really know where to start, if you just go to Looking Glass Education and along the top banner, you'll see something called custody service or CODL, then feel free to just reach out and we can help people with like hand holding them through a custody process and also just giving more options. Because one of the biggest ones, I don't know the demographic of your listeners, but one of the biggest ones is if you're a high net worth individual, storing millions of dollars on some of these small devices is intimidating. You don't want to necessarily store millions of dollars on one of these devices. And what happens if Bitcoin goes up and adds another zero to that? That is generational wealth. That if you were to lose it, that would be devastating. And so there are options these days, which we very much recommend, called collaborative custody. And so if you think about traditional corporations, no one entity can access the bank account of the corporation and go and spend all that money. That's a potential risk. So what ends up happening is you have 3 entities, let's say the CEO of a business, the COO, the Chief Operating Officer, and the CFO, the Chief Financial Officer. 3 of those entities have access to the funds, but in order to be able to move the business funds, you need any 2 of those entities to sign the transaction. The same thing happens in Bitcoin. You can have what's called a multi-signature wallet. You have 3 signing keys, and in order to move funds, you need any 2 of those signing keys to be able to move funds. And with collaborative custody, you as an individual would hold 1 key, one other entity would hold 1 key, and then we've got another entity that holds another key. And what that means is if one of those entities was to go under, it doesn't matter. They cannot move their funds on their own because they're only one of the 3 keys. While at the same time, if you were to lose your key, if something was to happen to you, if your house was to burn down, it doesn't matter. There's still 2 keys existing. And so collaborative custody for me is amazing for individuals that want that extra security. And I truly believe that it creates that ease of use where there's no single points of failure that we have with taking custody on a single little hardware device. But that's hopefully not too in depth.
Yeah. Yeah, that's the journey that I went through when I first got Bitcoin. The exchange is the bit for anybody who's never used an exchange. That's where you got to buy your Bitcoin. I think you can buy Bitcoin through hot wallets as well, I believe, some of them. But essentially, the exchange, FTX is an example of an exchange. Binance, what are the big ones? Are there Coinbase?
In the UK, I know, what is it called? Oh, I've completely blanked on the name of it. I can send you a couple UK-based exchanges because my mum lives in the UK. I've got a family that live in the UK and they use British-based exchanges. Yeah. And it's hard to find exchanges in the UK. The UK is quite hostile to Bitcoin. And the only reason why these nation states are hostile is because it's a threat. Just like when I gave the example of China. If
Mm.
the family wants to protect their purchasing power and invest overseas, that's a threat to China. So what do? They put capital controls in place. Well, the UK is a massive debt-based system. It's got immense amounts of debt. If you suddenly see purchasing power being taken and invested in Bitcoin, well, all of a sudden that's purchasing power that no longer can be accessible by the UK, the British government. And so they're going to put restrictions in place that prevent people from moving capital towards Bitcoin. So much of this media that we see in the BBC, the Telegraph, you name it, that is slamming Bitcoin is purely propaganda in order to try and scare people out of investing their capital that preserves their purchasing power. And so people are stuck in assets that do not preserve purchasing power.
Yeah, most is definitely, there's so much hostility in the UK towards Bitcoin. I had to change banks, like I was saying to you earlier. I had to change my bank because most banks, certainly the high street banks, but even some online banks only who are forward thinking, supposedly, have completely banned you sending money to anything or anyone that has the word Bitcoin in it. Any exchange that's obviously blacklisted. So I had to end up changing banks just for the ability to buy Bitcoin. I can go and buy cigarettes. I can gamble freely. In fact, as much money as I want. You could even use credit cards up until very recently to gamble. You could buy cigarettes. All of these things. But as soon as it came to cryptocurrency or Bitcoin, no, the banks decided we're not going to let you do that. And I find that totally bizarre that a bank has that level of control over what you can do. And this idea of cold storage and multi-signature and sort of total sovereignty and ownership of what you have is an idea that I think people have lost. I think years ago is something that when people owned physical gold, they probably had a lot more because they had this tangible thing where they're like, this is mine. This is mine. They can they can literally feel their wealth. So they kind of felt this sense of ownership. Whereas now, ironically, even though Bitcoin is completely digital, when you log into your banking app, it doesn't really feel that real. It is just numbers on a screen. So this idea of completely owning it on a USB style device, I think actually flicks a switch, and certainly did in my brain when I did it. And it is actually a very easy process because it's all kind of, I bought a Trezor. It was about, I think it was about 130, 140 pounds. And I only did that when I got to a level of Bitcoin whereby I felt this is too much to keep in an exchange that could potentially just take my money. So if you're scared and that seems quite intimidating, would you say to start on an exchange, something like Binance or whatever the UK ones? If any ones you send me, I'll put in the description of the podcast so people can go and have a look. Start on an exchange, then go to hot wallet, then go to cold wallet, and then potentially go to multi-signature.
And it more just depends on how much you're investing in. So the way that I think about it is between an exchange and a hot wallet, it's kind of like, what is the maximum amount that you would store in your wallet that if someone was to pickpocket you, you'd be upset, but it's not going to be the end of the world. And that's what I would store on an exchange or on a hot wallet. When it comes to cold storage, that is when, okay, this is starting to become part of my savings. And that's where I think it's really, really important. It's interesting as well, just to kind of give an example of like the potential benefits of Bitcoin. Like I finally persuaded my mum after years and years of kind of getting her into Bitcoin and kind of preaching about Bitcoin, finally persuaded her to invest a portion of her pension in Bitcoin. Amazing. And I think she invested a couple percent. And the way that I kind of described it is that if you think about real estate, or you think about equities, so stocks, or you think about bonds, well, how big are these markets? Well, equities is like $150 trillion globally. If you think about bonds is like $300 trillion globally. If you think about real estate is something like $350 trillion globally. The derivatives market is $1 quadrillion globally. Jesus. That's mind-blowing. What are the returns of these things? Well, real estate on average goes up between like 7 to 8% annualized over the last 100 years. Bonds goes up around 4 to 6% annualized over the last 100 years. Equities goes up on average around 8 to 9% annualized over the last 100 years. So let's just take the medium of the average of that. It's probably around like 7.5% is what kind of most of those assets kind of annualize over the last 100 years. Now, when we look at technological advancement, when we look at productivity, you name it, efficiency, prices on average fall between 5 to 15% per year. And we're not realizing that because of fiat currencies. So if we had a currency like Bitcoin, all of a sudden, these assets that are annualizing 7.5%, well, prices should be falling at 10% on average, 5 to 15%. Let's take the middle ground, 10%. That means that if we simply saved in the currency, we would outperform real estate, we would outperform equities, we would outperform bonds. These things have hundreds of trillions of dollars stored in them just to protect purchasing power. Bitcoin right now is trading at around the total value of Bitcoin is around $1.5 trillion. Just 1.5, not 300, not 1 quadrillion. So we're talking about hundreds and hundreds and hundreds of $1 trillion, which would flee these traditional assets into something like Bitcoin. So Bitcoin has the potential. I don't like to put a price target on things, but more just raising awareness to the fact that if we just had a monetary system that worked, Bitcoin has the potential to add zeros, multiple zeros onto the end of Bitcoin's price. And so if you are a pensioner and you invest something like 1% or 2% of your portfolio into something like Bitcoin, and we were to go through a recession where all of a sudden house prices drop 50%, stocks drop 50%. Well, if people during times of stress, they tend to flee from assets like real estate, assets like stocks, into things that have scarcity because they don't want devaluation. They don't want debasement. So they flee into things like gold. We've seen this throughout history. So instead of them fleeing into gold more and more frequently and more recently, we have seen people fleeing in things like Bitcoin. We saw it during the Greek default. We saw it during the trucker rally, during the pandemic. We have seen people flooding into things like Bitcoin, and Bitcoin's price has started to skyrocket. So if you've got 2% of your portfolio in Bitcoin, and all of a sudden your portfolio gets cut in half in your real estate and your stocks, but that 2% ends up going up multiple hundreds of percent, you can float your whole portfolio from that 2% holding. And so Bitcoin, if you think about it, it's an insurance policy on the breakdown of the current system. Even in relation to gold, gold is trading at, on the high end, $20 trillion. Bitcoin is trading at $1.5 trillion. So gold is, whatever that is, gold is like 13, 14 times the size of Bitcoin. Even if Bitcoin was to just match the value of gold, all of a sudden that 2% holding would have gone up 25, 30%. You've floated 30% of your portfolio from a 2% holding. And so when I think about Bitcoin, and the way I explained it to my mum, is that ultimately Bitcoin is an insurance policy on the breakdown of the traditional system, which we are increasingly seeing. In October of 2022, was it? British pensioners saw the pension system start to break down, and the Bank of England bailed out the pension system effectively. If that had not happened, they estimated that something like 80% of British pensions would have failed. If 80% of British pensions would have failed, that's immense amounts of capital lost. And so how do we protect ourselves? How do we have an insurance policy, an indefinite insurance policy on our pensions, on our savings? And that's where I think Bitcoin is a potential solution to that.
Seb, this has been an awesome conversation. I really hope people in the UK are more open to Bitcoin education. I hope that banks and the government are more open to it. Things like in America with the new ETFs that have come out. In the UK, I just hope that we are more open to the idea, even if it's not people allocating 2% of their pension to Bitcoin, even if it's just, it becomes in the lexicon of something that could be useful rather than
Absolutely.
scamming and Silk Road and I'm just going to stay away from it. I really hope that we, and I think we are with, there's a lot more Bitcoin podcasts popping up, and there's some really big UK based Bitcoin podcasts that I think are spreading the word, but I think it's so heavy in the US, and I'm not too sure about Canada, but certainly in the US, it's more accepted, and that's kind of driving the Bitcoin march forward. I know when China banned Bitcoin and all the mining fled to the US, I'm sure that played a big role in it because a lot of companies popped up and have become much more profitable off the back of it. But I really do hope that comes across to the UK, and just so people can kind of think of it as a potential solution. Seb, thank you very much for your time today. For anybody who's listened and is intrigued by what you've talked about, where would you direct them? I know you talked about lookingglass.com, but where would you direct people to go to learn more about yourself and Bitcoin?
So you can just find me on Twitter at Seb Bunney, and Bunney is Bunney. And there's Looking Glass Education, which is the platform that we founded that speaks to working class individuals, the average layperson, that breaks down a lot of macroeconomics, monetary history, finance, Bitcoin, you name it, just for the layperson without the jargon. And all of our content is free and accessible. We can also help with custody if people do have questions around custody. And just jump on, book a free consultation, we can chat about it. And then finally, a lot of the topics we've discussed, I released a book back in December called The Hidden Cost of Money. You can find it on amazon.co.uk. And that book basically just discusses how money really does weave its influence into every single aspect of our lives, whether it's the environment, whether it's our politics, whether it's businesses, whether it's the ability for us to be able to show up with more capacity. And I think it's really important for people just to understand just how powerful money is And if money is broken, what are the repercussions of that? And so that book, I've just been humbled by the response. And the final thing I'll say is that if you're listening to this and you're not in the financial position to be able to buy that book, feel free to reach out and just mention so, and I'll just send you the ebook for free, because I don't want price to ever be a barrier to someone's learning. I think that's really important. But again, Brian, I've really, really enjoyed this conversation, and it's always nice to talk to like-minded individuals.
Yeah, me too, Seb. Thank you. I think what you're doing is awesome, and the fact that you're trying to give this free education to people is something that we need more of in this world. And I think Bitcoin is potentially the catalyst for a lot of people as well to kind of this forward-thinking idea of improving humanity. I think Bitcoin plays a huge role in that. So thank you for what you do, and thank you for your time today, Seb.
Thanks.